sharing rights. I hope I'll have them because I have a presentation.
You wanted to check? Dear members, good evening. This is most awaited webinar. Today we are scheduled with the expert who, Mr. Dr. Tirthankar Patnaik ji. He is from NSE Chief Economist. And this is the event where we all are seeing the ups and downs, volatility, budget. After that, the Sunday, we are all in front of the televisions today, and then very eventful day. On this day, we are thankful to Patnaik, Dr. Patnaik for giving us the sufficient time to brief us on the important milestones, what are importantly impacting our capital markets. So with this, I request Suresh sir, who is the National President, CA K. Suresh sir. He is here to welcome and give the introductory address. I request Suresh sir, please take over the session, sir. Thank you.
Yeah, thank you, Prasad ji. Good afternoon to all of you. Respected Speaker Dr. Patnaik, Chief Economist of NSE, and other my dear members of ANMI and other people who are watching this webinar on budget. It is a well-known fact that budget is an annual feature and a BEHA event as far as India is concerned. In other countries, budgets are prepared and submitted, presented to the parliament, but not this much fanfare on the budget. But in India, everybody is looking at the budget for various aspects. An ordinary man will look at the budget, whether costs will come down of his day-to-day living. Similarly, other stakeholders will see their respective area of anything happens in their respective areas. So here today we are having an eminent economist to present the overall view of budget, finance budget of 2026. Please understand that being we are all in capital market, definitely we should know what are the things happening or what are things spelled out in the budget. Because it has repercussions as far as the stock prices are concerned, as far as the future of the country is concerned, so that, you know, it becomes easy for you to recommend few things to your clients, or you yourself can also see the importance of certain aspects. So from this angle, today, ANMI, as a part of its knowledge series, arranged this extensive budget discussion through the Economist, Mr. Dr. Patnaik. Please listen to it, and any doubt, please put it in the chat box. We will try to resolve as much as possible and be attentive and make it more productive. Thank you. Please over to Dr. Patnaik.
Thank you, Sureshji. Thank you for the opportunity to ANMI. I have a short presentation here. I will take viewers through the presentation. Let me try and just share my screen, please. If you could confirm if the screen is visible, please.
Yes, sir.
Okay, thank you. So the Union Budget 26-27, we would call it in short as one of confidence and continuity. There were various things that met expectations. There are places where, especially for the markets, maybe in the short term, expectations were not met. Some things that were expected did not happen. Some unexpected things happened. Various things. But from a macro perspective, from a top-down perspective, the thought process was clear, is that the budget marked an era of continuity. Budgets, as Sureshji very rightly pointed out, are rather mundane affairs in other countries. In India, of course, we take excitement to a whole new level. But the point behind making budgets as mundane affairs is twofold. One, you should have policy continuity. It's important that for investors, for companies operating in the economy, budget signifies policy continuity. That should happen. The second part, of course, these days, you don't necessarily wait for the budget for large announcements. We can see many. I can give several examples like GST, like income tax rules, like labor code rules, various things that have happened in the very recent past that talk about how, the budget need not be the forum for the government to make policy announcements. With that in mind, the thought process that we look at for the budget is basically how good was it in terms of fiscal prudence, how good is the math, how are how credible are the numbers. So I will show a fair number of those figures for you. The other thing that we also look at is from a long-term perspective. Are we looking at sustainability in terms of our growth trajectory? The budget should be a policy statement that basically enables future long-term growth trajectory, and which is what we'll see if the budget actually does that. So it is a balanced budget. You are looking at sustained growth. Growth has been, if you see post-pandemic period, growth has been above 7% on an average basis for India, and the budget seeks to continue that. There were no major tax changes. I see that as a positive in my earlier remarks on policy continuity. What has instead happened is rather than changing rates or rather than tweaking with rates, compliance has been made simpler. And there are several such examples, and which is what the budget effectively does. There are, of course, growth engines identified in every budget. It's not as if those engines do not work, away from the budget, but it is good that some things are coming up for focus, and there are points that are made in the budget that support certain things even more than others. And that would be, in this case, an MSME, or high technology places like biopharma, rare earths, textiles. There were several places that the budget has, outlined or separated for, major support. And ease of doing business and market deepening did happen. The new Income Tax Act comes up in 2025. The last one, as we all know, came in 1961. And again, I will speak a little bit on CapEx. What exactly is the expenditure of the government and how credible is it? And how useful is it for the long-term growth trajectory? My second part would be to just understand the fiscal math of the budget. Is it credible? And what is the fiscal strategy? What is it that we are trying to do beyond the sector allocation that we see usually? Quick thought would be, every budget has a framework. We've had, we had threefold kartavyas this time. What is it that the government of the nation should do? Typically, you should accelerate growth, as we all would absolutely agree. We would also agree that, the government should fulfill aspirations of a, young society. India has a median age of just about 28 years. And growth has to be inclusive. And that's what Honorable Prime Minister says when he mentions Sabka Saath, Sabka Vikas. So these are the things that are the broad frameworks under which the budget operates. The fiscal deficit snapshot is in front of you. The core part, just from because there are many numbers here, very simply, if you look at the second last column, the simple part is that we have a total expenditure of roughly 53 lakh crores. 53 lakh crore is what the government spends. And what is it that the nation spends, or rather what the nation earns, earning and spending? That number is about 393 lakh crores. So our number is based on 10% growth of what the CSO provided as an advance estimate for FY26. The number seems reasonable for now. And obviously the expense, and why am I putting up that number? Instead of a 393 number, if they had a higher number, that artificially makes your fiscal deficit look small. So it has been done earlier, and the budget in the last several years has not resorted to such things. The government spending, if that's very high, that should be generally understood as providing a fiscal impulse. It is reasonable in our case. So 53 lakh crores is just a 7.7% increase. And that's in nominal terms. Some would actually say this is a bit on the conservative sides. Total receipts are growing up by around 7.2%. Direct tax at around 11.4%. Indirect tax has been kept largely flat, 3% growth. So very, very reasonable numbers on the budget this time. I will go a little bit more detail on this. This is all the same thing as percentage of GDP. So we had, we've had a very clear and downward trajectory in terms of our fiscal deficit. So from 5.5% of GDP in FY24 to 4.8 to 4.4 which was met this time. And now for the next year, we're targeting 4.3%. Fiscal deficit is on the downward side. This is good news because fiscal deficit is lower. This is also not good news because fiscal deficit is lower. Why? As anybody who would look at national income, the lower spend from the government, which is coming up in a fiscal deficit, translates to a lower fiscal impulse. In an economy where consumption is seen to be iffy at this point at several levels, this is something that might put the budget to be conservative. But the budget still scores, in our opinion, very simply because you have a better composition and an improving composition of spend. I will talk about it in a little while. Now, let me go to each of revenue and expenditure perspective. After all, if the revenue numbers are good, or if the revenue receipts are good and reasonable, then only we have proper numbers. So revenue receipts are expected to grow at just about 7.2%, very reasonable again. The highlight here will be the bottom right chart, where you're basically seeing that the share of direct taxes in overall gross tax revenues is actually rising over the years. From the pandemic in FY21, that number was just about 46%. From there, it has gone to almost 61% now, significant increase. And why we as economists like this? Because the higher is the share of indirect taxes in the budget, the higher is the inflationary impact of that budget. Tax collections, again, very reasonable numbers. So overall tax collections are up about 11.4%. Again, very doable numbers. Numbers are pretty much, in fact, they are again, they are reflecting the weak nominal growth that we have seen in the last few quarters. Nominal growth has been below 10%. And so from that perspective, the numbers are fairly okay. By the way, the direct tax to GDP ratio is at 6.9, the highest ever number. This is again a reflection of good fiscal management. Non-tax revenues again are kept flat. Very ambitious numbers here do lead to expectations that do not actually match by the end of the year. Disinvestments, this is one place where there is some amount of ambition seen. I'm simply saying that given the last few years' experience, there are two sort of columns here in our chart on the right side. Notice that in some years, there are very, very aggressive numbers for disinvestment, and they are not effectively met. The last time we had disinvestment numbers met was in FY18, FY19. Other than that, the numbers are fairly, they get muted. This, to me, is one of the important parts of this budget. Very clearly, there is a strong and sustained focus on capex. You can see two things here. One is that over expenditure, the share of capex has been largely rising. If you look at figure 9 here, you can see that out of every 100 rupees that we have of expenditure, almost 23% today comes into capex. Now, what does that mean? This means that the expenditure composition of the government is towards nation building, towards exploring long-term growth trajectory, because capex does translate into future growth, unlike revenues. And this composition has been improving for the last, you can see from at least FY10 onwards. There's a sustained improvement, but between FY10 and 20, it didn't move so much. Now, of course, from 21, especially in the post-pandemic world, it has been it's been rising. This is also visible when you look at the capex to GDP ratio. This is one of the core reasons why India has stood out across the world as a country where growth remains at above 7%, despite a lower fiscal deficit every year. Ministry-wise outlay, I will not speak too much here, other than the fact that this year we've seen a good jump in defense in terms of size. Other places also for skilling, power, the numbers have gone up meaningfully. Revenue expenditure needs to be kept in check, and which is what essentially here. The only concern I would put here is that interest continues to remain a significant part of our revenue expenditure. See, these are things that we can't get rid of, and paying almost a third of your revenue expenditure in terms of just past recent payments, past interest payments is something that, something that we need to think about going forward. Social spending is higher. You can see in the numbers here. In every place, whether it is Awas Yojana or rural infrastructure or the Swachh Bharat mission or the education mission, and importantly, Narega, which is now called VBG Ramji, it will become on demand. There's been a slew of revisions made to the Narega bill, again off budget, in the theme of my earlier comments, which essentially means that there is much less dependence on off-balance sheet funding now, which is again a good side. The expense that comes in has been coming from the budget, from the budgetary support. And you can see this very clearly on the top right chart, where you notice that the center's share of the overall spending or the overall capex is now significantly higher, what it used to be. The average in between FY10s and FY20 would likely be around 40 to 43%. But certainly post the pandemic, these numbers have actually gone up. So most of the spending today happens via the government directly. Market borrowing, this is one cause of concern by the market. While the net borrowing number has not increased much, you see that number is essentially around 11.7, which was roughly slightly higher, in fact, than what we've seen in FY26. But the most important part is that there is almost $3 trillion of additional borrowing. And the only answer there is that there is a good amount of redemption that happens in this year, more than 5 lakh crores of redemptions this year. And that essentially makes sense that what it leads to us, what it implies is that while, overall borrowing remains largely similar from a net perspective, gross numbers are very different, and the RBI has its task cut out in terms of managing liquidity this year and managing the massive supply, the gross supply of money this year, paper this year. Debt fiscal strategy again remains very, very useful, very simple. The anchor in all budgets in the last several decades has been how lower can be your fiscal deficit versus last year. We all know that our government spends more than it earns, and therefore, the fiscal deficit, that number should be lower because you increase revenues or you curtail expenditure. What has changed in the last year is that the government has shifted away from a fiscal deficit indicator, which is an annual indicator, to a more long-term indicator, which is, though calculated annually, it can be used from a long-term perspective. So the government basically now says that what it said last year was that from 56% debt GDP of the center, we will now go to around 50%. And we'll do this before FY31, because that happens to be the last year of the 16th Finance Commission. That's the sort of thought process here. And where are we on that front? You will notice that the numbers for the central government are largely under control. We were about 57.4% in the immediate aftermath of the pandemic. We were roughly 60.1% during the pandemic year. But since then, the numbers have gone down from 57.4 to 55.6. I'm not saying this is any easy. This is not going to be easy. But there is a concerted effort to bring down the center's part of the GDP, center debt GDP ratio. Now, what is the concern again? For states, fiscal numbers are not so rosy, and we see you will see significant divergence across states, and overall states do have a more tough task ahead of them vis-a-vis the government. But importantly, as figure 23 shows, our debt GDP numbers are still lower than most advanced economies. US, for instance, is already above 100. Japan, yeah, bless the Japanese, they are at already 200%. France, Germany, there are several countries which have significantly high levels of government debt. If you look at debt, slightly broader sense, however, then you notice that overall debt can be not just from the government, which is center and state in this case, but also from households and also from corporates. So from that perspective, you can see that over the last 15 years, our household debt GDP ratios have gone up from 30, 32, 33 to over 43% today. Over 40, nearly 42, 43% today. So that's something to think about. Rising consumption, rising funded consumption is something that India is seeing. Our corporates had periods of high leverage, which is what you can see in the orange chart on the left side. They may be lower now, but notice that these numbers are around 52% of GDP. Lastly, our government. So, and I told you 50, 55%, 55 to 50% is what the central government is sort of, trying. But if you include state governments, the number is around 81%. Where do we stand vis-a-vis other countries? India's overall numbers are meaningfully lower than most other countries. But there is also significant room for improvement, particularly on the retail household size. So fiscal stimulus or fiscal consolidation. I would say fiscal consolidation is definitely happening, and this is amidst the, obviously because we have a capex, we have a strength on the capex here. But if you notice something very important, look at the bottom left chart. So in the bottom left chart, if you see general government spending on capex as a percentage of the budget, India is an outlier. India, Indonesia, these are outliers. Most other economies of the world do not have the same kind of spending that India has. For instance, the US, the number capex versus GDP is just capex versus the budget size is just around 10%. Most of it is otherwise revenue expenditure. And if you look at the tax GDP ratios, there, of course, there's a lot to learn from global markets because India's tax GDP is meaningfully lower than, say, a France or a Deutsche. That's it. I mean, these are the direct measures or so. I will stop here for questions. Just to summarize, a very reasonable budget, symbolizing continuity. There are things that may not have worked for others, but the broad thought is of market stability. If I look at what has been done specifically for the markets, I would say, you have total return swaps coming up for corporate bonds. You've had muni bonds, which will basically get a 1,000 plus 100 crore number, unlike the 100 crore number that we saw last year. There is, for trades, you're including it with JEM. There are many other things that are done for the markets. Also, in some cases, transaction taxes have been increased. So broadly, very supportive, not for the reason that I just said. In fact, for businesses at IFSC, the tax-free period has been increased significantly. The tax rate has been reduced. So there are many other positives that the budget has. My argument here was to look at largely from a macro perspective. And from there, the budget does not try to ruffle the long-term trajectory. And for us, that's a positive. Thank you. I'll stop here.
Well summarized, Tirthankar. And just if we have a couple of minutes, we can take a couple of questions. Let me pose the first one. What will be the impact of budget on capital market? Of course, we've seen the market behave the way they were.
Yeah.
And we got two events. But according to you, looking at the impact, one is the STT that's gone up. Do you see any specific impacts from the capital market perspective?
I think the thought process, Kamlesh ji, is about long-term continuity. It's just about long-term continuity. And, beyond what we will call Tobin taxes, beyond the immediate aftermath of taxes like an STT, it is important to notice how markets will be stable over the long term in terms of policy continuity. Markets will gain a lot more from a stable economy, stable economic growth, and that is where the budget really excels. It spends more in the right direction versus last year. It irons out various things. that simplifies the job of the ordinary investor. And from that perspective, it is definitely a positive.
Yeah, very well put. As you rightly said, continuity with confidence is something that the budget actually, reinforced from that perspective. One more look, if you see 18% GST, has it been withdrawn from FPI clients? Can you be able to confirm on that or give some clarity? The 18% GST
So,
for FPI.
what has happened is, yeah. So the relevant section that in the budget looks at the GST. The current budget seeks to remove a point that basically looks at the place of supply. So if you consider these things as exports, the services offered by brokerages as exports, at that point, exports will not attract GST. This is on one side, and there is a high probability that the government will go along those lines. But because there is no circular issued as of now to this effect, one has to also consider the second part here, which is that exports are earnings in a non-INR currency, unless you specifically show them that they are as they are earnings from exports. And in this case, the earnings are in INR. So we await some clarity from this on the government from the government in terms of a circular that clarifies that the GST brokerage services will not attract GST.
Well taken, absolutely. Yeah, some clarity needs to come out on this aspect. And another point is, you mentioned briefly that compliances have gone down. Are there any specific relaxation or increase in the stock exchange compliances by any chance? If you could highlight on those.
No, what I had meant was so you have disputes, you have a much longer window for taxpayers. Things have been made simpler. That's the point I was trying to make. It is easier now if you have tax disputes to look at it, and in a lot of places there is a clear sense that there is trust by the government. So when there were disputes, the earlier prepayment numbers used to be 20%, now they have been reduced to 10%. So at various places like this, the government has shown willingness to trust the taxpayer.
True. And while we've seen a bit of impact on the options market in the equity derivatives segment, did you read it also that there is a increase in the commodities options market, or that's been left?
I think it's left. In my understanding, it's only on from what I saw, it's only on the equity derivatives at this point.
Thanks. I think any more questions that have come in and I have missed, Prasad?
No, I think Suresh sir, you have any points to bring in, sir?
No, actually, Dr. Patnaik expressed whole thing in a very what's called beautiful presentations to make the people to understand budgets in a correct perspective. Otherwise, normally we look for tax concession or reduction in this, that, and we will miss the finer points of the budget.
True.
But he made it very clear that this is nothing but a continuation of earlier capital expenditure policy things, so that the stability is ensured in this budget. So it is always good to know such detailed way of presentation of budget rather than just a superficial way of only taking into account the tax concession, etc. Of course, all you know that income tax, etc., concessions earlier they have given, major concessions they have given earlier. That's why nothing is there in this budget. So that way it is a very straight and simple, but very transformative budget, I can say that.
True. I think, Doctor, thanks a lot. I think this is the bird's eye view. Whatever the gist has come to us from you is very useful to our members. And this is a closing remark. Like out of 10, if you rank it, how many marks you give it to it, sir?
Sir, my thought always has been of policy continuity. You keep
Super.
policy continuous, don't change things all of a sudden, then things are fine. And any budget that does policy continuity and therefore makes life boring in terms of change of strategy is a good budget.
Absolutely.
Don't rock the
As
boat.
an economist, your view is very clear. But as an investor, we were little tumbled or stumped by on that Sunday, and the investors received very depressive mood. So, however, this
Luckily, Trump rescued.
Trump, true. So Trump has rescued us. So this is a very great, sir. I think this is Kamlesh, Shroff, sir. You have any points to mention, sir?
No, absolutely. I think just to build on the conversation is, as he rightly said, continuity with confidence, is something, and a balanced approach with focus on the growth momentum while maintaining the fiscal discipline. So I think, and of course, clearly identifying the growth engines. And after, I think, almost 65 years that we have a new income tax act in place to simplify compliances. I think, it's almost all the points most of the points were touched upon by Tirthankar ji, and at the same time, keeping the fiscal deficit anchored around the 4.3, which is also nice.
Thanks a lot.
So,
I think this is.
So with
I
that,
request Kamlesh, Shroff, sir, to give vote of thanks, sir. It's a beautiful session. Out of his precious time he has taken out. So I request Kamlesh, Shroff, sir, to please give a vote of thanks. Thank you.
On behalf of ANMI, it's my pleasure to propose the vote of thanks for today's webinar, held in association with NSE on the Union Budget 2026, key announcements and market implications. Our sincere thanks to Dr. Tirthankar Patnaik, Chief Economist, NSE, for an excellent and insightful presentation. His clear analysis of the budget announcement and their market implications provided valuable perspective and practical takeaways for all of us here. We are grateful to NSE for their partnership and continued support in promoting market education and informed discussions. A special thank you to our members and participants for joining us today, and the ANMI Secretariat and President for organizing for ensuring a smooth and successful session. Thank you once again. We look forward to your continued participation in future ANMI initiatives. Have a wonderful evening. Thank you.
Well, nice of you, sir. Thank you very much, sir.
Thank you,
We
sir.
end the session here. We look forward for many more sessions in coming days. Thank you very much, sir.
Thank you, Patnaik ji. Thank you.
Thank you, doctor.
Bye.
Bye.
Thank you.